Hey everyone, in this video I'm going to share some of my favorite price action patterns and trading concepts I use in my trading. We'll begin by looking into a high impact concept I call the breakout pullback, which is a component of the breakout build-up strategy. So let's take a look at what's happening at this E-mini chart. Starting at this portion of the price action, after the market broke above this structural high, it bumped into resistance just under the 4900 level. After that, we see this rather large bearish move, but notice how it doesn't break below the level of that initial swing high. What this means is that, technically speaking, the overall structure of this uptrend is still intact. In other words, it hasn't been violated. So even though we had this bearish hiccup here, the market is still considered to be in an uptrend. Then the market, as it feels this imbalance zone, switches gears and flips bullish, climbing back up, as you can see from the chart, through a 30-point demand bar as it returns to the previous resistance level. And now here is the key thing to pay attention to. When the market reached the same high point, again up here, it didn't sell off as much as before. This time the drop is much smaller compared to the initial one. So what is that telling us? Well, it means we have entered what's called a high compression phase within this consolidation period, which is like a tug of war between buyers and sellers, with energy building up on both sides. But here's where it gets really intriguing. During this compression phase, where the price's tendency is to cluster around the level it's trying to break, we often see a dip in volume, which is like a brief timeout in the action. It is that moment of calm before the storm hits, if you will. Now, another key point to highlight is the price clustering around the resistance level instead of immediately reversing downward. This indicates strong bullish intent as buyers are gradually absorbing the opposing orders present at that level. And now, as the price builds up or gets squeezed tighter and tighter within this compression phase, the tension keeps rising. Traders, and as these higher lows show, are literally on the edge of their seats at this point, waiting for that defining moment when the price finally breaks out of the range and makes its big move. That defining moment is when we clear the high here, as the price closes the candle well above the resistance level. However, the real star of this pattern isn't the break of the resistance level, but rather what comes right after. You see, when the price manages to break through and close above the resistance line and then retest the same line as support, that's when we know we are onto something. Now, the cool thing here is that the breakout and retest or pullback usually happen pretty close together just before the market really starts to take off. And by the way, this type of bullish breakout that perfectly, I think, describes our breakout action here is referred to as the breakout pullback strategy, which can help confirm the strength of the breakout. And now it's worth mentioning that sometimes after a bullish breakout, the price won't bother pulling back to retest the previous resistance line as support. Instead, it will just continue to charge upward without looking back. So don't be surprised if you see the price taking off immediately after the breakout. Of course, to seal the deal, we should ideally see a candle closing above the top that formed after the breakout, giving us the extra confirmation we are looking for. All right, now that we have covered how to confirm bullish breakouts, let's switch gears and briefly explore an example of a bearish breakout. So what we've got with this chart here is an uptrend that's been cruising along, but then the market shifts and starts moving sideways, creating this period of consolidation. During this phase, we have several lows being established, which basically form our support level. And now, just like bullish breakouts, when you are trading bearish breakouts, it's a good idea to wait for a candle to first break and then close above the support area. Why, you might ask? Well, because more often than not, this this closure serves as a confirmation that the breakout is actually happening, and it's not just a false alarm. So in our chart example here, you'll notice that when the bar closes below the support area, we've got ourselves a higher probability bearish breakout. Once that breakout happens, the price enters a confirmed downtrend. Why do I say confirmed? Well, pay attention to how this upward retracement doesn't quite manage to break above the closing price of the candle that initially broke through the support level. That failed attempt, which obviously reflects trader sentiment on the price. This failed attempt here to balance this imbalance area tells us that the bearish breakout is likely the real deal, and we can expect more downside action to follow. It's all about letting the market show its hand before making your move, guys. It's simple as that. Okay, let's now move into a different trading concept that can help you avoid those low probability trades that often lead to a bleeding account. I'm talking about using Confluence. And I'll try to demonstrate this concept using a double top, which is a bearish reversal pattern that usually appears after a prolonged upward move. Now, as you already know, double tops are formed when the price hits a certain level but can't seem to break through. But here's the thing, to make the most of this chart pattern, we need to look for confluence. That is, we need to find additional technical factors that support the idea of a reversal. With that in mind, let's take a look at this chart. What we first notice is that we've got a market that's been mostly dominated by the demand side, pushing the price up in a steady uptrend. But then after this mini reversal, a rejection takes place. The bulls try twice to break through this resistance level and fail both times. What this does is it raises the possibility of a trend shift. However, we can't jump to conclusions just yet. There's always a chance that the buyers might regroup and give it another go, finally breaking through that resistance area. But that's where Confluence comes in, to really confirm that we are actually dealing with a double top formation. We need additional evidence to back it up. That evidence comes in the form of a neckline, which is this horizontal line here, connecting the lows of the double top pattern. It is an important level that, when broken, as is the case with our chart example, when broken, often confirms a reversal. Also, let's not forget that the neckline of the double top acts as a support level. Now, if this level gets broken and the buyers can manage to push the price back above it, while the sellers are busy driving the market below the support, something interesting happens. And not only do we end up with a flip zone, as in support turning resistance, but more importantly, we get a higher probability confirmation that we are indeed dealing with a double top formation. But at the same time, just because we see a breakdown happening, it doesn't mean we should rush to short the market like there is no tomorrow. We still need to take a step back here and look for more confluence or more signs that support the idea that shorting is the right move. And that's why I have included the MACD indicator, short for obviously moving average convergence divergence, as an additional factor to give us deeper insights into this specific trading area. And as you can see, we have the MACD line crossing over the signal line here and indicating a potential sell signal. Obviously, this further aligns with our bearish bias and strengthens our confluence. Another bearish confluencing factor I'd like to point out here is this head and shoulders formation within the same price action we are analyzing, which is an interesting occurrence. Notice the market on the second attempt convincingly breaking below the neckline, similar to the double top pattern, though in a more measured way. Obviously, the neckline here is basically this support level drawn along the bottoms between the head and shoulders. So this break, particularly when in sync with the double top break, typically signals a bearish trend continuation. Also, it's important to note here the market's extended upward movement, which is met with rejection upon retesting the neckline, now acting as new resistance. This shift can be categorized as an RMPDP, short for what I see as a reassessment of the market's price delivery process at the neckline level. It's worth noting that if resistance had been convincingly broken, it would have altered the short thesis for this entire price action scenario. And now the failure to break through this resistance area serves as a signal that the market might be struggling to move past this point, which is why you should take note of this dynamic as you plan your next move. So after this brief analysis, we basically have four confluencing factors supporting a short entry. Firstly, the double top pattern clearly indicates buyers' inability to maintain upward momentum. Secondly, the neckline breakout and crucially a close below it confirms the seller's tendency to shift the market's direction to the downside. Thirdly, the MACD indicator signals a downtrend. Obviously, as an indicator, the MACD it's not a magic crystal ball, but it can certainly help you make sense of all the ups and downs in your chart. Not all the time, but most of the time. Lastly, the head and shoulders pattern, this sequence of lower highs and the demand side's failure to break through resistance signal trend continuation. As I always stress in this channel's videos, guys, trading is all about making analytically informed decisions, and the more factors we can find that point to a high probability trade, the better off you'll be. And by the way, you can use the same trading logic employed in the double top and head and shoulders strategies for double bottoms and inverse head and shoulders patterns. The only difference is that for entry you go short on double tops and head and shoulders when the price breaks below the neckline or support, and long on double bottoms and inverse head and shoulders when the price breaks above the neckline or resistance. Next up, let's talk about the 1, 2, 3 wave pattern. This pattern is pretty neat because it's known, relatively speaking, of course, it's known for its effectiveness in spotting market reversals. Now, the 1, 2, 3 pattern consists of three main points. Point one, this is the starting point where the price begins to move in the opposite direction of the prevailing trend. Now, as the market begins to reverse, it forms higher lows, which lead to a break in market formation or market structure, signaling that a reversal is likely underway. Following the first move, there is a retracement or a temporary pullback in price, meaning the market is pausing and taking a breather here before deciding where to go next. And now, to complete the pattern, we are waiting for a third point. This is where the price breaks past point 2, signaling that the reversal is in full swing and a new trend is emerging. This is the point where you can often see the market go for wave 4 and even wave 5 as it continues extending. I think that a clear break and close above point 2 is key for traders looking to rake in on the market's new bias. Another important point to consider regarding the pattern is wave number 3. There will be instances where the market may print below the level where the structure initially broke. This is often a stop hunting tactic used by smart money to trigger retail stops before pushing the market higher. So if you come across such a fake out move, don't be fooled. It's simply a liquidity grabbing maneuver. And if you are interested in delving deeper into the concept of stop hunting or liquidity grabbing, then click on this video next.